And welcome back. It's Jason Walter here. There was some big news that was announced on Friday that's impacting indirectly our housing market. So I want to share this with you guys. It says the Dow Jones closed more than 300 points lower on Friday, posting its worst week since June as Silicon Valley Bank collapsed, which caused a sell-off for the stock market. So for example, the stock market tumbled on Friday as tech-focused lender Silicon Valley Bank shut down falling losses in its bond portfolio, prompting the biggest bank failure since the global financial crisis of 2008. And because of this, the Dow Jones fell 345 points on Friday, which is a decrease of 1.07%. The S&P 500 decreased by 1.45%, and the Nasdaq fell by 1.76%. Therefore, for the week, the Dow Jones fell by 4.4%, posting its worst weekly performance since June of last year. Regulators took control of Silicon Valley Bank on Friday after shares tumbled on Thursday, and the bank struggled on Friday to find another company to buy it. And this collapse of Silicon Valley Bank overshadowed February's jobs report, which is also announced on Friday. In that jobs report, they showed actually signs that inflation could be slowing. Payrolls increased more than expected, but investors focused on the smaller than expected gain in wages, which may cause the Fed to rethink its aggressive stance on rate hikes this year. And speaking of February's jobs report, it was reported that non-farm payrolls increased by 311,000 for the month, above the 225,000 that was estimated. However, though, there was some good signs on the inflation side, though, because hourly earnings climbed 4.6% from a year ago, below the estimate of a gain of 4.8%. Also, the monthly increase of wage gains was an increase of 0.2%, also below the 0.4% estimate. So the reason why I'm mentioning this in today's video is this really is going to be impacting rates. Because look at this. The 10-year Treasury as of Friday decreased by 22 basis points down to 3.70%. It was really close to 4% on March 1st of this year. So just about 1 week ago, the 10-year Treasury was around 4%. Now it's at 3.7%. And this is really impacting mortgage rates. Look at this. According to the Mortgage News Daily for Friday, average 30-year fixed decreased 24 basis points. Now it's at 6.76% for people with exceptional credit, of course. Jumbo is at 6.35%, and FHA and VA is at 6.25%. So this means that over the span of the past 2 days, average 30-year fixed rates have decreased by about 30 basis points. Going from just over 7% just a few days ago, now they're at 6.76%. This means compared to 1 year ago, that rates have only increased by 2.48 percentage points compared to 12 months ago. 12 months ago, average rates were at 4.28%. Also, because of this fallout of Silicon Valley Bank and because regulators have taken control of it right now, the street is now forecasting the Fed is going to increase the federal funds rate by only 25 basis points in about a week and a half from now. Yesterday, they were forecasting for the Fed to increase rates by 50 basis points. So on Friday, now the expectation is, with a probability of about 60%, is that the Fed is going to increase rates to 5%. That's a 25 basis point rate hike. In contrast, on Thursday, the street was expecting a 50 basis point rate hike. Now it has been completely reversed. Now they're expecting a 25 basis point rate hike in their next meeting. Also, for their next meeting, or so for their May meeting, they're expecting the Fed increase rates by 25 basis points once again by a probability of 57%. Then in June, or in mid-June, they're also forecasting the Fed raise rates by another 25 basis points. So on Thursday, the street was forecasting for a 50 basis point rate hike later this month, followed by 2 consecutive 25 basis point increases. Now the forecast is for 3 consecutive 25 basis point rate hikes. And again, the reason why I'm sharing this information with you guys in today's video is this right here, this giant decrease in rates by 24 basis points on Friday. If the trajectory continues to go downward, in other words, if rates continue to decrease, that could cause home buying demand to increase like we once saw in the beginning of February this year. But of course, time will tell, and I'll definitely keep you posted because in my personal opinion, the direction of our housing market this year is going to be largely impacted by the direction of mortgage rates this year as well. And changing gears here, let's also talk about some other reports here as well. So I also want to kind of focus on some early indications of home buying demand in today's video. So according to Showing Time, which tracks real estate showings across North America, for the week ended March 9th, the number of home showings by real estate agents across North America increased by 18.3% compared to the first week this year. Compare this to 2022. At this time, we had a 24.2% increase. Back in 2020, this time, right before the onset of COVID, at this time, we had a 30.4% increase. So in other words, this year we have 18% more real estate showings over the past 7 days compared to the first week this year, which is an increase, of course, but well below the past several years. So that was the number of real estate showings across North America, according to Showing Time. Let's also have a look at pending home sales, which of course is a measure of contracts being signed between buyers and sellers. So for the week ended March 5th, pending home sales are down by 29% compared to the same week of 2022. It's also interesting to see here that the total number of pending home sales is more or less in line with 2020, but again, far below 2022, which is in black, and far below 2021 right here as well. So for example, in early March of 2022, there's approximately 60,725 pending home sales. Now there's approximately 43,000, a decrease of 29.1%. And again, it's worth mentioning here that contracts being signed is still increasing, but not increasing at the same rates over the past several years. And of course, it's worth mentioning here that contracts being signed are still increasing, but not at the same rates we saw back in 2022 or 2021. So it appears we have this kind of a seasonal uptick in home buying demand, but still well below the past couple of years. So that's information regarding the demand side. Let's have a look at the supply side. So new listings, according to Redfin, have decreased by about 22%. New listings were increasing right here. They are still increasing, but not the same rates. So the number of new listings we have right now are far below 2020 through 2022. I mentioned that in a previous video, but I want to mention that because the reason for that is right here. This is according to a new report that was posted on March 6th by Black Knight, which is a data analytics firm that supports the real estate and mortgage industries. So according to them, half of all mortgage homes, in other words, people who have loans on their houses, half of those have rates at or below 3.5%. And also 2/3 are at 4% or lower. So the reason why people are not listing their house for sale is of course because the vast majority of people have rates below 4%, whereas right now rates are about 6.75%. Therefore, because rates are so much higher right now compared to the rates that people have right now, people are holding on their houses and are deciding not to move, or instead of selling their houses, they're deciding to rent out their properties. So what we have right now is kind of this tug and pull with buyers and sellers. We're seeing a decrease of contracts being signed. We're also seeing this huge decrease of home sellers who are selling their houses, or I should say homeowners who are deciding not to sell their houses. So kind of have this tug and pull between buyers and sellers right now, a decrease in demand, but also a decrease in supply as well. And speaking of supply, it's going to be really interesting to see what happens with housing inventory over the next month or two, because right now is a time frame when inventory tends to increase. Obviously, it decreases during the winter months, but it tends to increase in the spring months. So looking back at 2019, for example, which is March 8th, 2019, just after that, housing inventory started to increase. We also saw that back in 2018 as well. Back then, there was approximately 790,000 houses for sale. And after that, especially during the spring home buying season, inventory increased. That happens every single year, except for, of course, 2020, where we had COVID lockdowns. But it's going to be interesting to see in March and especially in April whether or not housing inventory starts increasing because it has been decreasing. So over the span of the past 12 months, inventory has been more or less decreasing ever since November last year, which again is entirely normal, but we should see this slight uptick or increase in March this year. But if inventory does not increase, this is likely due to the fact that people do not want to give up their historically low rates because new listings have been decreasing greatly this year. The reason why I'm talking about this is that this 25 basis point decrease in rates really caught my attention on Friday. If we continue to see this decrease in rates, that could cause home buying demand to increase, which of course would put upward pressure on prices and of course would put a downward pressure on inventory levels of course as well. But of course, time will tell, and I'll definitely keep you posted because I am not a real estate market fortune teller. So please comment below with your biggest takeaways from today's video. Also, if you guys got any value in this video whatsoever, then please hit the like button. I really appreciate that. And of course, I appreciate you. Hope you guys have an awesome day and look forward to seeing you on the next video.